Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a bit of a different guest. She wrote this book at one time. This was number 22 on Amazon, Fed Up. The author, Danielle DiMartino Booth. She's deep experience in Wall Street, journalism experience, wrote for a big newspaper, but her big experience was a special advisor to Richard Fisher at the Dallas Fed. Let me bring her on. Danielle, thank you for joining us today on USAWatchdog.com.
Great to be with you.
You're a perfect time to be on. They just raised rates a quarter of a point, which is kind of bizarre. I want to talk about your book in just a minute. Get into more about that, your Fed experience. But what's going on with the quarter point rate hike? What is the Fed trying to do here? They're trying to unload their balance sheet. They're raising rates into what looks like a downward economy. What are they trying to do with this quarter point raise?
Well, they're trying to do the opposite of what they did a year ago because the people who occupy the White House have changed. That's the only feasible answer that I can come up with to explain the Fed tightening into a weakening economy.
And you think this is politically motivated? You think they're trying to kibosh the Trump administration?
Their own metrics don't lie. Non-farm payroll growth has slowed appreciably over the last 12 months, and their favorite inflation metric is back below 2%. These are the rules they've made up, not me. And they're actually working and making policy against their own rules. There has to be a reason for it.
You think it's politically motivated? You think they're trying to basically turn the economy down because they don't like Donald Trump?
Well, I'll nuance my answer with the following caveat. Stephen Cohn, Steve Mnuchin, I think that they're very much in favor of having Yellen stay in office. With that being said, I think there is also a fear at the Federal Reserve that they're so far behind the curve that they don't have any ammunition left when recession does arrive. But that really doesn't, that still doesn't provide justification and cover for them to tighten into weakening, which is what they're talking about doing, especially when they raise the subject of shrinking their mammoth balance sheet.
In your book, this is a great book, incidentally. I mean, I can see why it was 22 on Amazon. Of all the books, thousands and thousands of books in the world, it was number 22 and number 1 in a lot of categories. But you, in the book, you start out around chapter 2 with a 5% Treasury rate for the 10-year Treasury, and in chapter 16, this is in every chapter you have this. At the beginning, chapter 16, which was 2013, the Treasury rate was 2.30. The debt since 2013 has grown $4 or $5 trillion, and now the 10-year Treasury is 2.1%. The debt is growing, and the Treasury rate is either static or actually falling. And the Federal Reserve has a trading desk. Can you account for how the Federal Reserve has got falling 10-year Treasury rates, and then they're manipulating it with their trading desk?
Well, you used the correct word. The only way that you can fabricate this kind of a surreal balance between growing debt and falling interest rates is to manipulate that into being. And that's exactly what we've seen. I'll give you a little anecdote. The very first time I was single in New York City and reading Bridget Jones' diary, I thought it was the most clever way to open chapters by having little metrics here and there. Now, they were much different metrics as they applied to Bridget Jones, but I felt like it was the right thing to do for the reader to help them know that the debt was growing, the size of the balance sheet was growing, and the 10-year was declining.
And the only way they can do that is with their trading desk. I mean, they're manipulating the markets with their trading. That's illegal, is it not?
Well, it's the power of the printing press, and it is not illegal. What is questionable, however, is the mission creep at the Fed and the fact that they went into credit allocation as opposed to purely being in the Treasury market. That's called choosing winners and losers. Mario Draghi at the European Central Bank, he's taken this one step further by buying corporate bonds. And Kuroda at the Bank of Japan has taken it one step further still by buying into the stock market. But again, these are central bankers gone wild. This is outside of their purview. It is the worst form of mission creep that we've seen in modern day central policy making.
And I just want to kind of disclaim this here. I was hoping this is going to clear up. We do have a video lag. Your sound is crystal clear, perfect. But there is a video lag. But what you're saying is so important. I'm just going to go ahead and continue to go on, with the interview. I want to go back to the metrics. We are going into a declining economy according to the Fed. We are declining, correct?
Not according to the Fed, according to the yield curve. If you look at the difference between the 5-year Treasury yield and the 30-year Treasury yield, it's at the lowest level since 2007. And we all know what followed 2007. The Fed can only do so much if they're not actively increasing the size of their balance sheet, and they're finding that it's impossible for them to fight the true message in the yield curve, which is reflecting so many industries that had supported our very anemic, feeble recovery, turning and peaking and rolling over. I refer to autos. I refer to the energy industry, which has been in a long slump despite oil prices being off their lows, and even housing. We've begun to see troubles emanate from that sector where everybody had hung their hat at the beginning of this year.
So, in other words, the data shows, in your estimation, that we're headed down. We're headed into some sort of a market crash. I mean, there's a lot of big, important people out there talking about the risk and talking about the debt in China metastasizing. It's not just a U.S. problem. There's a lot of important people that are worried about how this goes, and it's way out of whack. That we're set. Another important, money manager said we're setting. Al Arian said that. What did he say? We are setting ourselves up for a big market slowdown, a big market basically turnaround because of how big the bubble is. Are we facing a big turnaround because the bubble is huge?
Look, Stanley Fischer himself, in a recent speech, said that he was concerned about residential real estate on the global stage. If you speak to China, if you speak to the world, the Fed would like to maybe think that it can make policy in a vacuum only for the U.S. economy. But the fact is, as we learned in the aftermath of the housing bubble bursting, we live in an interconnected global economy, one that in 2008 and 2009, the credit markets were closer to $200 trillion in size. Today, they're much closer to $300 trillion in size, and we still can't say what and where the next systemic risk lies.
Well, one of the risks would be Syria. I mean, the U.S. just shot down a Syrian jet, and Russia has been giving strong warnings and flying really close to our aircrafts in other parts of the world. It looks like it is heating up. We just shot down a Syrian drone, and yet the gold market is not taking off. Is that being manipulated and held down by the Federal Reserve's trading desk, gold?
I don't think that the gold market is necessarily reflective of that. If you look at a long-term graph of gold and you treat it as you would any other asset class, I think gold is in the late stage of a very long correction phase. Once we get a sniff of true market reaction to any of these geopolitical events occurring in our midst, I think that you could see gold take off like a boomerang. A hockey stick, better said.
You think gold could go way up? You think it could really take off and turn around? You think we're at the end of well, some people call it manipulation, some people call it a bear market, a lot of people call it manipulation. You think it could turn around big time?
The European Central Bank has said, and a lot of the Germans right now are very much in favor of the intrusiveness of the ECB backing off. If you have more than one central bank in a tightening mode, I could see the potential for serious slowing in the economy. I'm speaking counterintuitively right now, so bear with me. If there's any slowing in the global economy, then the ultimate safe haven will not necessarily be U.S. Treasuries. The ultimate safe haven is gold.
And I want to talk to you about your former boss, Richard Fisher, which, we see one all-time high after another. But before I get to that, Well, no. Let me go ahead and get. Richard Fisher said came on CNBC, sat on set. I saw him say this. I have a piece of tape of it, and said something to the effect of, we injected cocaine and heroin into the markets, to create a wealth effect. And everybody on Wall Street is, I guess, making the bet that the Federal Reserve is going to continue to inject cocaine and heroin into the markets. I mean, you just had Dudley this week say that they are determined to hit their inflation targets. Is everybody, sleepwalking when the Fed is telling them that people like your former boss, that they're injecting cocaine and heroin into the markets?
I think that there is a working assumption among those on Wall Street that if there's any disruption of any sort, and you can call that a true 10% correction in the S&P 500 stock market, that the Fed is going to come riding to the rescue with QE4. They may or may not be right. If the Fed is politically inclined to put the economy in recession, they'll whistle past that graveyard and not give the market the heroin that it so desires. But the Fed has yet to back off in the face of major market declines, at least as far as the last 30 years go. You'll recall, here we sit in June. August is when Alan Greenspan became the chairman of the Federal Reserve, and the rules of engagement changed. I'm sure you remember Paul Volcker. Yeah. God bless him. He really didn't care one flip about markets and how they reacted to Fed policy. He was going to do right by the country.
And that's why we got a 30-year or 35-year bond bull market. He raised up to the moon, and we just had that sleigh ride all the way into today, correct?
Well, the sleigh ride was also facilitated by somebody putting some oil on the slopes called Alan Greenspan. Again, every time there's been even a whiff or a threat of a major correction and the ability of what we call creative destruction to level the playing fields and to make it a more competitive landscape for American companies, some central bankers ridden in and prevented that from occurring, which ends up creating more debt. The more debt you have, the more debt you have to service, the less money you have to spend on other goods and services in the aggregate, the more you're going to depress interest rates. It's simple math.
And you're saying that because of what the Fed is doing right now, actually raising rates into a declining economy, and you think it may be politically motivated, you're saying that, hey, y'all, watch out. The Fed may not be riding to your rescue if we get into big trouble this fall. Is that what you're saying?
Well, I think that, let me put it differently. The Wall Street Journal ran with a story the day of the Fed meeting. When the Fed rose interest rates, the Wall Street Journal put a front page story about Gary Cohn looking for potential Fed successors to Janet Yellen. But before you even got to jump to the inside of the Wall Street Journal and finish reading the story, you read that Janet Yellen was one of the contenders. If you want the Fed to come riding to the rescue, then you leave the most dovish Fed chair in recent history right there at the helm.
So you think that she may end up staying, and that's how we get this hockey stick move in gold, that they will just say, okay, we can grow the economy and have some inflation, or we can not have inflation and we can kill the economy. Wouldn't that be the choice that they have?
Yes, and they're neither of them are good. And despite the fact that they might want for QE4 to be the magic white bunny that they pull out of the hat, we have to recognize that we're in the third longest economic expansion in U.S. history and the second longest bull market. The Fed can buy time at this point, but the time is much more expensive on the back end than it is on the front end in terms of the financial instability that it creates today that has to be cleaned up tomorrow.
Do you think they're going to, they have a motivation to keep housing prices up and keep interest rates low because they're selling this giant balloon, of all their mortgage-backed securities. It's not their book, but they have a couple $1 trillion in mortgage-backed securities that was, toxic asset when they bought it. Now it's worth something. So, with them, don't they have a motivation to keep this party going until they unload this book of business?
They do, but it's a needle they can't thread. Bear in mind, the Fed has only said that it's going to start shrinking its balance sheet. If you look at the message in the market, if you look at the message, especially in the bond market, investors do not believe the Fed. So I think that it will be a game changer the minute they let one security roll off of the balance sheet and not replace it, thereby keeping the price of those mortgage-backed securities high by the very fact that they're the ones coming in and buying to replace them. I don't know that this market is prepared for the Fed to become a seller, and I don't think, I'll have to push back, I don't think the Fed's capable of propping up prices while selling off its portfolio.
So you're saying that either you keep your portfolio and hold interest rates down, or you sell all your junk and rates are going to have to go up.
And let it go. Yep.
Oh boy. Well, I mean, it just sounds like a bad scenario. I mean, handicap this fall. Do you? And I'm not trying to get you to pick a date, but it just seems like that we just shot down a Syrian jet. Russia has broken off all our, peace, love, and happiness with working together in Syria for the exclusion zones and not, flying our fighters into their fighters. That's all broken off. We just shot down a drone. Russia's flying, 5 feet of our aircraft in the Baltics. So, I mean, this is getting worse. Could this be the black swan that knocks the Fed out of its saddle and causes things to go haywire? Syria?
Well, I think if you tack on the fact that we've had 5 months of slowing auto sales vis-a-vis last year, and think about that. We're talking about a third of manufacturing jobs in this country. I get it, manufacturing doesn't matter. But manufacturing at the margin is still big enough to lead the economy down. I've just finished writing an opinion piece about the fact that when you aggregate the bloodletting in brick and mortar retail, what's coming up in restaurants, which nobody's talking about, what auto dealerships are looking to do with the land underneath their properties, when you aggregate all of this and the fact that we can't seem to get oil closer to 50 than to 40, you add all this up together and there is a perfect storm brewing for commercial real estate in this country, which is highly overvalued, and throw a black swan or two, as you're alluding to, geopolitically, and again, you could have a confluence of factors that the Fed could not fight.
If we get commercial real estate hitting the tank, wouldn't that follow suit through to residential real estate? Wouldn't the Fed be holding toxic assets once again? And
well,
everybody else?
There's no apples to apples comparison, but there is a wealth effect that is real and true, unlike the tooth fairy. There is a wealth effect on the way down. The people who the Fed have propped up the most in the current era of unconventional monetary policy, quantitative easing, what you will, the very same people the Fed has benefited the most will close their wallets, they will cut their wives off from their Visa and MasterCards and pull and rein in, and we do live in a consumption-led economy. When commercial real estate hits the skids, high-end residential real estate, which has really been the only game in town in this recovery, will certainly follow suit, to your point.
And I wanted to bring up one other thing. You have a consulting firm. I should have brought this up in your introduction. I'm sorry. Forgive me, I did not do it. But you have Money Strong, an economic consulting firm. So what are you consulting people to do in this environment?
Well, unfortunately, I'm in the position of having seen a lot of bubbles. And what we know about bubbles is that they defy logic. They go on for much further than anybody can anticipate. I tell them what I told people when I was back on Wall Street. Take your principal off the table. If you insist on being at the casino, then at least take your principal off the table and only let your profits ride at this point. Then you'll be able to wake up, look yourself in the mirror in the morning, and know you're not going to have to go start your career all over again.
All right. I'm sorry for the speed problem, but listen, I'll put up your website. It's DanielleDiMartinoBooth.com. They're all the books. There's several places to buy this book, Fed Up. Fabulous book. I mean, it's absolutely fabulous. And I love the way you did
it was designed to be readable. That's what I can tell you. And actually, tomorrow we're rolling out a whole new website to mark my 2-year anniversary of having left the firm. So it's been a great 2 years being at Money Strong.
This book is fantastic. I'll just put up the link to your Danielle DiMartino Booth website. You got plenty of places to buy it on there. This is the book, Fed Up. An insider's look, and I should have read the best part of the cover. An insider's take on why the Federal Reserve is bad for America. This is absolutely not a pro-Fed book.
Greg, I'm going to ask you to do me one favor. I want you to read the dedication, which is one line.
Where's the dedication? It is.
It's just a few pages in, and I think it'll be a nice way to sew this up.
Okay, and here we go. I dedicate this book to every hard-working American who wakes up in the morning asking themselves what went wrong. I want to ask you one more question. That's great. That's great in this book. I want to ask you one more question. Have people at the Fed and the deep state, I don't know, call them whatever you like, have they told you that they hate this book and they hate you blowing the whistle on the Fed and how terrible it is and the corruption? I mean, every chapter in this book is something negative about Wall Street or the Federal Reserve or corruption or insider trading. I mean, it's unbelievable what you've documented in the book, and you got, I don't know, 40 pages of notes and also sourcing in the book, which is fabulously done. Have people on the deep state, the dark side, the dark powers, whatever, the Fed, have they complained to you about this book?
There's been some very subtle pushback from the establishment, and I'll let that sit out there. The purpose of the book was to call into question pure academics who have never had to run a business and have never been on the receiving end of the policy they make. By that same definition, these pure academic PhDs would never consider to read a book such as this because it's not written by one of their own. But you did mention those endnotes, and it's a book written first and foremost to be readable, but second, it's written in their own words.
Well, sourced. I mean, that's the scary thing about it. You don't say anything in this book that doesn't have a source, a reference, a policy. I mean, look, Fed officials might not admit to having read the book, but I promise you, their attorneys have told them that I've not said anything that wasn't sourced. Oh, I'm sure this was lawyered up, but it's fabulous. I mean, people say all the time, they talk about certain stories on the internet, which, I said, listen, why would I chase stuff that I can't back up? There's so much I can back up. Why would I chase crazy stuff I can't really back up? Maybe true, but I can't back it up. Ma'am, you backed up your case, and I hope you sell more of these books. The book, Fed Up, the author, Danielle DiMartino Booth, 9 years as a special advisor to Richard Fisher at the Dallas Fed, who's retired by, at this point. Danielle, thank you so much for joining us today on USAWatchdog.com.
Thank you so much for having me.